Welcome to TheoTRADE. This is Don Kaufman. It's November 1st, 2024. Just about an hour stands between us and this weekend. So here we are on Friday afternoon. The S&Ps are up some 28 handles. There's all kinds of volatility, not only this week, but the week prior. I mean, the S&Ps have had some pretty spectacular two-sided trade, which I'm going to show you here in just a moment. I am well aware that there is an election next week, but I got to tell you, what is really kind of the 800-pound gorilla in the room right now? Yeah, the bond vigilantes, they're here, they're present, and that, people, is what is going to be driving markets moving forward. All right, let's explain that and much more right here on this weekend update. Okay, to kick this off, like, look, I could spend all day, talking about the S&Ps and different levels they're at. And I was talking about two-sided trade. Yeah, we're starting to see some two-sided trade. There's no question about it. Actually came down and touched the low of a range that we set in place, back in kind of early October. So a range that's been in place for quite some time. By the way, what you guys are looking at right now, this happens to be a 30-day, again, a 30-day, if you will, 1 hour. And you can see we dropped literally right back to that previous range over here. So we're back in it. But again, as I was saying a moment ago, yeah, push it all aside. It's all for nothing. Look, what the primary driver of the marketplace is right now and what has become, it is the bond market. And if you're not looking at it, again, look, you don't have to trade bonds. You just have to know, okay, what is going to be driving this because, well, there's an election coming, which we're going to talk about. Possibly regardless, okay, of what the outcome of the election happens to be, there's bond vigilantes, and they're not just here in the U.S. They're actually, in European markets as well. And, the British pound was getting hammered. And, British, again, bond markets were all over the place throughout the course of this week. But now they appear to be hitting, the U.S. Treasuries. And when I'm talking about this, and some people are not really familiar with the entire terminology of kind of bond vigilantes, that actually comes out of the 1980s. And it had a lot to do with fiscal policy. And I'll just kind of break it down for you because, as I said to you, and again, I say this without hesitation, okay, it's serious. We have a very serious interest rate problem ahead of us. This is the bonds, okay, which is the /ZB. This is the notes. Obviously, some significant sell-side activity in here. Now, for those of you that do not speak bonds and notes geek, when the notes, in this case, by the way, what's the difference between bonds and notes? It's probably a good place to start, right? Well, I'll tell you the exact difference between bonds and notes, all right? These notes are good for 10 years, okay? These bonds are 30 year, right? It's just duration. So I zoom in and I'm actually looking at the notes right now. It's pretty obvious. There's some dramatic sell side activity. I mean, this thing has barely had an uptick in here. So what's the cause for concern? Well, the bonds and notes, okay, the sell side activity in here is inversely proportional to interest rates. So if you see a big sell off inside of the ZN or ZB, that would actually cause interest rates to go straight up. And that's, again, talking about bonds and notes is kind of like a foreign topic to a lot of people because you may trade some Microsoft, you may trade whatever, like you get it, but you don't necessarily look at the bonds every single day. I do. I mean, I traded these things for the better part of 25 years. So this is the TNX, okay, and this is the SIBO, okay, 10-year interest rate. And I've been bringing this up a lot lately, but what you have here, and I'm going to get into really detailed specifics over here, is the Fed went out and cut interest rates. And everybody knows that. They cut by what? By 50, okay, basis points. So the Fed cuts by 50 basis points, and that was right in this neighborhood here, and yet the interest rates have exploded higher. And I want to bring this up because the interest rate was 3.6%. Now we have the interest rate closing in very close to 4.4%. We're not quite there, but really close to 4.4%. That, okay, is monumental. It's huge. It's huge. In fact, when I start zooming out in the chart, okay, and this is just the interest rate, and this is the interest rate that affects you, and this affects your mortgage, okay? You look on a 3-year, like, wow, that's Quite the little move. I mean, we've seen some big moves to the upside, but this one is staggering, especially considering everybody's expecting interest rates, of course, to go where? To go down. So in the 1980s, there was this terminology that came out of like bond vigilantes. And basically what it implies, okay, is like, for instance, fiscal policy in the United States gets a little out of control, spending's a little out of control, okay? All of a sudden, okay, those that own bonds, they've had enough. They've had enough and they start selling the bonds. Why do they start selling the bonds? Well, first of all, they get a little nervous like, hey, they're going to be able to pay this back. Okay. But what's really also going on is they're demanding higher interest rates. Okay. Why? Would you want to take this kind of risk? I mean, the debt is spiraling out of control. And again, it's, it is what it is. I'm not trying to, any policy decisions over here. I'm just basically saying the debt is spiraling out of control. Okay. There's an election coming. And I do believe that the bonds are trying to make a statement right now. Okay. The bonds are trying to make a statement. If you don't cut spending, and that's talking to the United States government, if you don't cut spending, okay, the interest rates are going to explode on you. And it doesn't matter. Like the Fed can cut, okay, their overnight rate, and they are going to cut it. But here we go. So we're actually seeing this dramatic sell side activity, which is bond investors just demanding, like, if you will, higher interest rates. And it is ugly out there. Meanwhile, the jobs report came out today. All right, non-farm payrolls came out, and the number was really bad. It was 12,000. So it was expecting well over 100,000 jobs in creation, and yet we hit 12,000, which is basically like the same thing as like a negative number. And the interesting outcome of that right now, okay, is the initial knee-jerk reaction is, all right, so if jobs get really, really bad, and this is why I'm super concerned about this now, but if the jobs number is bad, you would think, wow, that means the Fed is definitely going to be cutting rates, except that the bonds, they initially rallied and then sold off dramatically. That's not a good sign. That's why I'm saying the bond vigilantes, they're here, okay, and they're getting real out there, and it's no joke. If these things do not turn around in the next couple of days, okay, that's it. You're not going to be able to sustain the S&Ps near all-time highs. Things are going to get wild in a hurry because you're at a point in time in the bond market where sell-side activity begets more sell-side activity. I mean, you're going to have some banks that are going to have to dump positions over here because if you bought bonds, and I want to show you something interesting here, anytime in the last 15 years, okay, this is a 15-year chart in the bond market. If you bought bonds anytime in the last 15 years, basically, you're down money. There's only been one, maybe two places where you could have bought bonds and you're actually doing okay. In a 30-year, you're getting freaking killed. And these banks are getting annihilated. Okay, but it doesn't matter because the banks are like, well, it's an unrealized loss. Meaning the banks can, as long as they can actually hold the position. And the problem is some of the banks can't hold the position anymore. And you may actually see some dumping in this bond market. Okay, so that's easy enough to state. Yeah, the real problem is, what if the bond market doesn't like who wins the election? Now we compound the risks. Okay, so for instance, if a Harris administration comes in and they're just going to spend like crazy, okay, just forget it. If a Trump administration comes in and they're going to cut taxes, forget it. Bond vigilantes are going to take over this marketplace. One way, shape, or form, people, this could get like really, really serious in a hurry. We're going to be watching this market, okay, day in and day out. And I can't stress enough. We have a very serious interest rate problem right now. And you're starting to feel some of the impact of this because today was a rip-roaring rally inside of the S&Ps, okay? And it's a rip-roaring rally. Maybe we get a little bid back under us. That's fine, okay? But as soon as the bonds really started a steep decline, okay, it actually pulled the S&Ps back quite considerably. And the S&Ps, they're their own animal. They're rallying back a little bit right now. It's all going to be okay. 50 minutes to go to the cash close. We'll see how it plays out. But it's getting dangerous, okay? And I believe that we are right on the cusp of a major move down in this bond market. And this actually becomes the primary driver of equity markets, because I'm going to tell you right now, those bonds continue to sell off. Everybody believes that their, tech is impenetrable. Bonds will not impact it, until bonds actually have a little bit of a fire sale. Now we've seen that, okay, and recently we've actually seen that. Let's go bring back a 3-year. This is where bonds, these things got ugly for a period of time. Some sell side activity. This is no different. We're right at a point where we could see acceleration of sell side in here. look for it again, because I think that would actually be a key figure in trying to ascertain what the future of these S&Ps is going to be. And that's why I said you're going to have a lot of people that are going to tell you all kinds of stories about different levels inside of the S&Ps. The only story that matters right now, okay, the bond market. That's it. And I'm telling you right now, the election, okay, it's almost like secondary compared to this. And it's just going to be, even if you had the election results in your hand right now, and I'm dead serious about this, like if I had election results in my hand, I'm still not sure I could actually give you a feel for what this is going to look like. And I'm going to tell you exactly why. Okay. First of all, a Trump administration comes in, well, maybe they don't win the House. Okay. And vice versa. If a Harris administration comes in, okay, probably not going to take the Senate. So you're going to get gridlock in Washington. Boom. The bonds are going to get smoked. Why? Okay. Because these monkeys, I don't care which side of the aisle you're on, these monkeys aren't going to get anything through, which means there's not going to be spending cuts. And I'm not one that's to talk about, treasury debt and so forth. Okay. I'm not one of the people it's the end of the world. I am telling you though, the movement, okay, and the volume inside of these bonds, it's not just unusual, it's huge. And it is definitely, okay, a serious concern right now. Normally I would, it's okay. It's just this marketplace, but you start looking around the world just a little bit here. This is the British pound getting all kinds of wild. Like look at the last, just 24 to 48 hours, the British pound, okay? Huge sell side activity, huge sell side activity inside of the British pound, rallies back up, all right? The UK has serious debt issues in there, okay? And their bond market, gilt is just all over the place. But you're seeing it in currency products everywhere. This is actually the Japanese yen, okay? Do you think that that's natural? Okay, it's not. All right, this is Japanese yen, and this is actually around our employment situation. Nothing makes me feel warm and fuzzy like, an employment situation. Non-farm payrolls come out in the United States and we get rocked, just absolutely rocked, okay, and like the Japanese yen. And that's more of a question than it is an answer. You can see the euro, everything is reacting to it. But this bond market, again, getting downright scary. All right, let's move onward and upward from there. The next thing on the docket over here that I'd like to talk about a little bit about. So some earnings came out. Microsoft got hit pretty good to the downside. Actually caught all of this too in an earnings butterfly. But Microsoft takes a little bit of a hit. Okay, Apple, some sell side activity right now. But the reality, okay, of it, and of course Meta, some sell side activity in here. The reality of it all comes down to NVIDIA. Got to watch NVIDIA into next week as well. And again, push aside the election for just a moment. What you think about the election, NVIDIA is important because now you're starting to think, whoa, this could actually be it. Is this going to be a little bit of an AI unwind? Okay. And it doesn't matter what Microsoft and Apple are trading. Clearly, as long as NVIDIA is up, okay, you got a marketplace that's going to be happy. And it's because not only is NVIDIA a $3.3 trillion market cap, okay, but really what you've got is NVIDIA that is sitting at a 60% implied volatility in the back month, where other stuff out there like Microsoft is like a 24 vol. I mean, NVIDIA's volatility is absolutely insane, which, if you look and you're like, oh, it's a $3.5 trillion company that is Apple, so it's bigger than NVIDIA, okay? Yeah, but the problem is NVIDIA's implied volatility is double, okay, or even beyond double. And that makes it, okay, that much more dangerous. It is the trade that you have to watch right now because it does appear that some of these tech companies might start curbing some of their spending. Why? Well, their investors are getting punchy. Everybody's like, hey, show me the money, okay? And nobody can show anything from AI right now except, okay, for NVIDIA. And then you look over at SMCI, which has just turned out to be, look, it's bottom line, it's a scam. It's a scam at this point, at least until told otherwise, until they can find an accountant that actually will stick with them. By the way, if you guys have no idea what I'm talking about, the accountant, Ernst & Young, walked. They actually, third party comes in and they, check the books and so forth. And they said, we don't like something going on in here. This thing's absolutely been decimated. So the AI trade is now being a little bit called into question. everybody is starting to look at their own books and see if the spending's actually worth it. So again, things are getting real in a hurry over here. And I've noticed a lot more volatility, okay, is starting to hit inside of NVIDIA. And that's, again, outside of anything election. Speaking of election, let's start to talk a little bit about it. All right, apparently we have an election coming. You know, the fact of the matter is there are markets for elections, right? There's probabilities. Everybody's pretty familiar with, you know, like Smarkets and Polymarket and all the different betting sites and so forth. Look, I'm going to give you a bit of a different take. As I said to you a moment ago, even if I had the election results sitting in my grubby little paws right now, I don't think I could tell you what's going to happen, because it's not about the S&Ps, okay? It's the influence of policy, okay, to me, upon the bond market that's actually going to cause the S&Ps to move. But I will tell you this, there is information in the S&Ps that's incredibly useful. So let me actually break that down for you, because maybe some people are familiar with reading this and some people are not. We're looking out literally until next week. So there's daily expirations, right? So this is Monday, Tuesday, Wednesday, Thursday, Friday. If you look over to the right-hand side of the screen, which I'm highlighting right now, you look at implied volatilities, right? So, you know, Monday, kind of chill. So, you know, Monday's kind of a chill day. It's like a 10% vol and starts to jump up a little bit on Tuesday. But look, Tuesday is like 12% volatility, because we're not going to know anything by Tuesday for the election, right? Here we go. Wednesday things start rocking. Oh, so by Wednesday, we might know something, or up to a 21% vol. That's when markets really get going. But Thursday, Friday, okay, they kind of take the cake. The interesting thing is that the volatility for next week does peak specifically on Friday. Why is that important? Because it's kind of like a summation, if you will. Okay, in summation, what it basically means in reading into this volatility, because then the volatility starts to drop off, okay, thereafter. Not by much, but the volatility definitely drops off thereafter, okay? It's very likely, according to the SPX implied volatility, that we will actually have some results, okay, by the latter portion of the week. So coming in, like, you know, you're almost at a 24 vol for Friday. It looks like the latter portion of the week. At least that's the way that the marketplace is pricing it. So there's a lot of people like, we're not going to even know, okay, who's going to be the president for weeks, for months. It's going to go court cases. Yeah, but according to the SPX right now, it's a little bit more cut and dry than that. Okay, so I don't know, but I would tell you this: Twitter, better known as X. Okay. Oh, the humor on there is great. I don't care which side of the election. They have brought back comedy. That's the best part of the election. All right. Onward and upward, because I wanted to give you a deep read into there. Onward and upward. The earnings. The earnings for us has been butterfly mania. We have hit butterflies in Intel, Apple, Amazon, Microsoft, just to give you a quick feel. For those of you that are not familiar, strategy I'm using a lot lately. It's called earnings flips, which is basically wrapping butterflies around this. But I'll give you guys a kind of a quick feel for some of the trades that I've actually done. Okay, examples. Okay, could be like an Intel. So if you look at Intel, just some of my fills, went out and actually bought a butterfly for 39 cents, closed it for 95 cents. And that basically amounts to 144% return. So 144% return inside of Intel. Next in the docket was Apple. Okay. By the way, all of these butterflies were hit in the last 2 days. So in Apple, I went out and bought a butterfly for 78 cents. Closed it for $2.20. That amounts to 182% return inside of Apple. Next one on the docket, okay, Amazon. So in terms of Amazon, went out and bought a butterfly for 48 cents. Closed it for $2.15 in Amazon, a 348% return. And last but definitely not least, okay, I have Microsoft. Went out and bought a butterfly in there for 91 cents, closed it for $2.50. It's 169% return. So we are hitting with butterfly mania. And you know, something even interesting for today. Last week I actually hit the butterfly in the SPX. If you guys kind of missed that one last week, in fact, I'll even back up a little bit and show you like the last like 15 days in here. But last week, I hit the butterfly in the SPX. I bought a butterfly last week for 60 cents. I closed it for $3.45, right? Okay. This week, I paid 35 and 30 cents for butterflies respectively in the SPX. They don't look like they're going to hit, but we're not that far off. I can see it. We come down to like 5,700, and it's winner chicken dinner for these butterflies. So it's the volatility picked up, right? We're getting two-sided trade. I love this stuff. Another trade I hit this week is I actually was in and out in 24 hours, actually, of NVIDIA. We were talking about the AI trade. It's one of the reasons I'm watching NVIDIA so carefully. I think there's actually some good trades, even like throughout the course of a week inside of NVIDIA. So I'll be all over that, of course, next week. So look, next week, Monday, Tuesday, whatever. But on Monday and Tuesday, you can get more positioning inside of the bonds. If the bonds, okay, start getting more sketchy, the S&Ps are not going to wait for the election results. And again, I'm telling you, things are getting edgy out there, really edgy. The bond market, okay, it is breaking. That is probably the biggest summation. All right, last but definitely not least, got to talk about the SPX, the mother of all products. Why? Well, the week that is just about to close out, we're going to close out a week here in just the next 40 minutes trade, okay? The week that we're going to close out, we had just about $105 expected move. So the expected move, the week we're closing out, is $105. What happened this week? You know, Monday, Tuesday, Wednesday, absolutely nothing. A little bit of two-sided trading here, okay? Coming in, of course, to Thursday, people, look at the hit, okay? I got to show this because if you look at this carefully, like it didn't hit the expected, look, okay, at the move into literally the last minute of trade yesterday. Winner, chicken dinner. Literally hit, okay, to the penny. This is a $5,700 product. We're talking about pennies over here that we missed it. Okay, you got to pay attention to this expected move stuff. If you don't, you're missing it. You're just simply missing it. Now, why is this so important? Well, because you're coming off of a week with a $105 expected move. Okay, what do you got next week? Ooh, this is what I was just talking about a moment ago. I'll tell you exactly what you got. Right now, we're estimating somewhere in the neighborhood, and again, the market's not closed yet, right? So we're estimating in the neighborhood right now of somewhere near $150, okay, expected move. So, ladies and gentlemen, put on your big boy pants because you're coming out of a week that $105 expected move, and you're like, I'm exhausted, man. That Thursday and Friday were wild. Yeah, okay. Well, they're going to amp up the vol by the tune. It could be as 40, 50% higher implied volatility. And I have to tell you something. I like it. Okay. This is the kind of trade that, you know, we wait for. Elections, it's going to get good out there. And by the way, if you're on TheoTRADE, yeah, during the evening of the election, as results start to come in, we'll be here. Okay. We're not leaving our computers. Most of us are actually going to spend the night in our offices. Okay. We'll be here throughout the entire election. And well, at least me, I'll be watching some currencies and I'll be watching the bonds. Although, look, I am heavily into S&Ps and heavily invested right now in terms of tech stocks on the short side, okay? Yeah, you better believe, though, you got to pay attention to the bond market. You got to pay attention to currencies, okay? Something's wrong with the marketplace, and I believe it's because the bond vigilantes, they have shown up. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.